The broadcast is now starting. All attendees are in listen-only mode.
Hello and good afternoon. I welcome you to today's special webinar. Let's call it live trading of the US market opening. My name is Jens Klatt. By the way, good afternoon in my case. So I'm located in Berlin, Germany. Probably listen to this webinar, I don't know, somewhere from the US or so. And it's in the morning around 10 a.m. Probably if you're located on the East Coast, somewhere in New York or something, or good evening if you're located somewhere, let's say in or good night in Australia. This is a global webinar, so I just speak as if someone is listening from Berlin, Germany right now to me. And yeah, I welcome you to today's webinar where we want to stress test the strategy which I presented already on Monday. And we want to have a look here at how it performs on the real market conditions. Some of you might be surprised now. I can talk here without hurrying up. That has something to do with the fact that we still have 14 minutes left. Some of you might remember what was one of the key parameters. We have to define a range here, and it has to be defined between 3:30 p.m. German time till 4:15 p.m. German time, and 4:15 is in 14 minutes from now. So currently we do not have yet a range which we can then trade. So that gives us enough time to click here through the risk disclaimer first. And please remember that trading with financial instruments offered by Admiral Markets here carry a high level of risk, which is probably not suitable for all investors or people who listen to this right now due to their complex nature. And before entering into any agreement or transaction, that you please read the terms and conditions of the service from Admiral Markets. Please consult a specialist if necessary to ensure that you understand the risks involved in trading, and you should also study carefully the so-called KID, the key information documents, in order to understand the nature, risks, costs, potential gains and losses of margin products offered by Admiral Markets. So then the question arises, even though I think that some of you probably have checked out the website already from Admiral here, why Admiral is a very, very good choice. That has the first place to do with the fact that in the CFD universe, the offering from Admiral Markets is highly competitive. Currently, for example, thanks to the anniversary of the DAX, who turned, or the DAX who, which turned 30 at the beginning of this month, the typical spread, which is already one of the lowest spreads in the industry, in the CFD industry, was lowered again to 0.5 points here. I highly recommend checking out the website here from Admiral and claim your advantage here based on a very, very low spread. And then the regulatory background. Admiral Markets is authorized and regulated by the so-called Financial Conduct Authority, or short FCA, in London. This is also, or can also be seen here, why we go through the risk disclaimer in detail here. This is how you can contact Admiral, and then this is me, plus here is our 3-step intraday trading strategy for the S&P. We want to go through this again, and start from there, then adopt it or work with this under real market conditions. And then also, not only because you will find out that, in fact, trading, a proven profitable trading strategy is something which is very, very boring. In fact, you will just find out that we define the open range, that we identify our advantage, and then we place the order gets filled. And in fact, we do not work with a take profit level or with a trailing stop, even though it's possible to do that. But in our case, we work with a so-called time stop. If we're not getting stopped out, which we hope, within during the trading day, we take out the order then 10 minutes before the spot market closes, which is at, in my case, 9:50 p.m. German time then. So therefore, again, we will have a look at the DAX, also based on the fact that this highly competitive offering here of 0.5 point spread is currently available at Admiral. and how the strategy here, which can be adopted to several markets, not only to the DAX, but also, for example, to the FX markets. We will have a look then at the DAX and how it performed today. So in fact, the market currently trades in our favor based on the open range setup here to day 2. But first of all, let's have a look at the S&P. So first step is we have to define the open range between 3:30 to 4:15 p.m. German time, CET, Central European time. So that means we still have 10 minutes to go until we have the high and the low of this period here. And then based on that, we can say, okay, we have to identify our advantage, which is crucial in trading. In fact, trading without an advantage means you're trading for sure with a negative expected value, and trading with a negative expected value in trading means nothing more than your trading is unprofitable. So you have to identify the advantage, and the advantage will be identified thanks to the exponential moving average 10 on a 50-minute time frame. Simple. If the S&P 500 trades above, we will trade the S&P 500 long. If we trade below, we'll trade only the short side. I've already shown some examples on when no trades were done here. We also can have an example. I'm not sure if I will find one with the S&P. This is also due to the fact that here, for example, the 15-minute exponential moving average 10 is very close to the current price. But in the DAX, for example, there have been several of those occasions when we traded, for example, below, in case of the DAX, the exponential moving average 50 on a 5-minute time frame, while we broke out of this open range here, which is defined in 1 on the upside, and no trade was generated thanks to the trend filter, which that we trade below, so we're not taking any trades here. And we have to wait until the market retraces to the breakout level and probably take the trade from there if it retraces at all. So that was something which happened, I'm not sure, was it on Monday or was it on Friday last week? I don't know. But back to the S&P setup here, and then what we'll do is we trade the break of the open range in direction of the identified advantage. The stop will be placed above or below, depending on whether we're going short, long or short, of the range. What I haven't included here is how we take our profit, if there is a profit. But again, this is a time stop. So if we are not stopped out, we take out the trade at 9:50 p.m. German time, so 10 minutes before Wall Street closes, and we have no other choice than to wait this time span here of, in this case, around 5.5 hours, and the trade stays open. And you will see, by the way, that it works. We'll also have a look at the performance and the market conditions under which this strategy really performs really well. We'll have a look at yesterday, where the S&P generated a nice profit, in fact. And you can also see that under such market conditions we found ourselves in yesterday, it doesn't really matter if you're working with a take profit level or a trailing stop, or if you work with the time stop level. That seems, at first glance, it seems like, okay, this is ridiculous. What do you mean? You don't need to run a strong market analysis, good market research, doing good market research, and spot areas where we could find a strong resistance or support zone. Yes, that's exactly what I say. Because if you run a backtest over years here, you find out that in fact the strategy performs extraordinarily well with such an approach here, and you don't need to be, let's call it a market wizard or top market analyst or something to spot such areas. But in fact, the time stop out here in this case, taking, or time take profit level, let's call it, still results in a very, very impressive result then. And so before we go over to the DAX, let's have a look here at the picture, how this looks like. So there you can see those thin lines. This is the high and the low of the first 3 15-minute candles. And then we trade the break out of this range here on the upside long, since we are trading above this blue line. So long setup is triggered, and this is where we take out the trade. It's 2,724, and as you can see here, that was close of the high of the trading day. So now it's time to switch over and have a look here at the S&P. So currently, and this is, by the way, something, so probably it's a little unlucky, because the thing is, after such a run here we have seen yesterday, chances, in my opinion, are good that probably there's no big price action taking place today. So to just give you an idea of my trading here, my personal trading for today, I was long the DAX yesterday. And in fact, it took a little until the market really took off. So let's have a look here at the DAX then. So I was long here in this region. The strategy is different from the open range setup. It was a complete different strategy, even though you can see, or you can imagine, that this squeeze higher here, we won't go into details here now why this is the case. Probably that makes sense to have or to give it a look here on Friday then, when looking at the weekly outlook for the last week, but also give an idea on why this squeeze really happened and occurred here. And so after the market really took off then into the afternoon, and we saw this squeeze, in fact, it was a short covering, which is potentially induced, or was potentially induced, from the Eurex. This is where the FDAX is traded, respectively options on the FDAX are traded, and these options expire on Friday. So there's only a small expiration. It's not that the options and the future contract expires, but it's the options market which potentially induced this squeeze higher here. And after such a run, it's not uncommon that the market stabilized at an elevated level. Potentially, I said probably we will drift higher, let's say, not seeing another sharp rise like this yesterday, but probably stabilize on an elevated level, probably trade a little higher, probably consolidate a little, but all in all, we shouldn't see a big drop. Probably it will happen tomorrow, not sure, but I can tell you the following. I know that my system would have been short today, so this is definitely a market environment under which I don't want to be short, because I highly doubt that there's a good chance today, from a risk-reward perspective, that we correct most of these gains from today. And also, I know that tomorrow, and this is getting more and more likely, depending on what happens in the upcoming 5 hours, sure, with the US markets. If they crash down now, potentially I will be short tomorrow. But all in all, it looks as if I will be long tomorrow with this system. Now, the thing is, if this system is long tomorrow, I also know that the risk reward after this consolidation at an elevated level, that the risk reward is getting unattractive for long engagements. That means for this system, for example, even though this is purely discretionary trading, but I take out the trade then, and I'm not trading in this case this system, but I intervene from a discretionary perspective. That's that way, by the way, I try to optimize the expected value. So now let's come back to the S&P. Why do I mention all this? Well, it has to do with the fact, what can we expect today? I have to say, volatility really collapses. We should also have a look here. Therefore, 1 second, please. We should also have a look here. So these are the webinars. This is, by the way, the weekly market outlook I was just referring to here, which will be held on Friday then at 1 p.m. German time. You can find all this under education and Forex webinars on the website from Admiral. But I want to have a look here at the VIX, the volatility index on the S&P, and this collapsed again. So if we go down now to where, let's have a look here. Can we? The full chart. I want to show it to you in full. That makes more sense. Let's just hope that it opens. Yeah, but what we have to do right now is nevertheless hurry up a little. And currently we can already place an order. So it's 2,806, 807. And the stop will be at 12.4. So we will use here this tool, which is great, by the way. I will introduce to you this tool a little later. So let's first of all place in this order here. We'll risk 1% of our equity. It's 1%, and we have to place a stop. Therefore, it's 2,812.4. Take profit, not placed. And why do I work with a sell stop? Currently, we can see we're trading slightly. It's just slightly, but we're trading below the blue line, which is the exponential moving average 10 on a 50-minute time frame. And that's why we will trade the short side here. So there we go. Now we can place the order. Oh, great. Okay, that's that was not good. 1 second. Let's do it again. So now we have to work with the limit. I was just not fast enough. No, let's do it that way. I was just not fast enough. The market moved too fast. So let's do it again. Now we have to work with the sell limit. Let's do it that way. Stop loss. And then we work with 812.4 and do it that way. So now it works. So what just happened was that I tried to. Now, oh, you can see now we traded slightly back. I was just not fast enough. So that's the big difference when you're doing this manually. When working with an expert advisor, for example, you're not scared, let's say, if the order is placed accordingly, because this works faster than what I just did. And if the market then already breaks lower and it's trading below this at this level which you wanted to sell, obviously you get a what's the word for this? Not mistake. What's the word for this? Failure. So well, the platform just tells you, sorry, but I can place the order. Let's put it that way. So okay, yeah. Now we already got filled. You can see it here. So this is also great. What you could see is that I work with the sell limit. So if we are now trading below this thin red line here, this is the low of this trading range, and you place the sell order, and then the market jumps back. The great thing about this was that it was already adopted. So it's no there's no let me just watch this. I know the word, but somehow I forgot it. 1 second, please. So in German, the word is, by the way, Fehlermeldung. Let me just, yeah, error message. Sure, it's an error message. You get an error. That was the word I was missing. So the great thing about this is you don't get this error message again. But the tool here works then with a sell stop if the market trades back to this limit. So it adopts accordingly, which is quite nice. Yeah, but just for explanation purposes, what just happened here. And so yeah, that's it. What just happened is that now we could easily end this webinar and nothing would happen anymore because trading is boring. That's something I already emphasize or all the time emphasize, and many can't believe what I'm talking about. Many think that you have to sweat in front of your screen and really watch every tick here. But in fact, this is not necessary. What's necessary is to have a proven profitable system and just trade it through. It could be that you're now probably getting stopped out because the market probably turns around. And this is, by the way, something where I have to say, well, I'm not sure whether I really want to be short today on the S&P because, and now we just hope that here, no, it's not open yet. Why is that? So usually there should be a chart which shows you the volatility index, the VIX. Yeah, there we go. So, and if we now go to, let's say, I'm not sure if 5 years, probably a little too much, but let's just see. Huh. Fascinating. Fascinating. Let's do it again. So the website is bloomberg.com. Let's type in VIX. Let's click on this one here. So there we have it. Then we click on full chart. To have a chart we can really look at. And then let's see if we can go down here to, let's say, 1 year. That's not so cool. Let's try something else then. There's another website which is really great, highly recommendable for input around financial markets. It's called Market Watch, and we can search Market Watch 2 here for the VIX then. And there we have it also. But what I can already tell you is that 12 is quite low. So we can take out Bloomberg then and just hope that here for 3 years we get a chart. Yes, well, that gets the job done, I think. So everyone can see now. that currently, after especially here, this massive short squeeze of volatility in February, the market calmed down massively again. And so currently we are trading back to the lowest levels since the end of January here, shortly before the squeeze happened. We are in a period of a very calm period of the year with vacation right now taking place. And so with all this said, chances are not that high that the market will sharply sell off. The same is true when looking at, for example, the fact that yesterday the S&P pushed aggressively higher here. That was something I already mentioned. So after such a push higher, even though that's not massively, it's okay. But usually you don't expect sharper moves the day ahead, not on the upside, but also not necessarily on the downside. So that said, chances are potentially limited that there will be a significant push lower here. The only thing is that, on the other hand, there is probably a chance that rather sooner than later, and you just do not know when this will happen, if it will happen at all. But what we can say is that this move here in dollar yuan, which took place or is taking place here over quite a long time span right now, this large devaluation of the Chinese renminbi here, also or mainly due to the or with target to counter the trade tariffs from the US here on Chinese products. The thing is that rather sooner than later, probably Donald Trump will step up and use Twitter here to announce this here, address this devaluation of the Chinese renminbi, probably then using this to drive, let's say, speculations higher, that the market participants start to fear a new escalation of the trade war again, which is potentially risk-off driver and could push markets lower. But nevertheless, the thing is that I have to say that here currently I somehow doubt that there will be serious momentum on the downside. But, and this is the thing, and this is something you have to remember yourself of, if you backtest this result as this strategy here, this is the result you get over a time span of, in this case, some similar or close to 7 years. What you can see is that there have been plenty of these occasions under which volatility was low, when there was a chance that there will be an announcement made which could be bearish for the markets, and there will be times when you just wake up on the right side of variance, let's say. So some might say this is, you get lucky. Well, and sometimes you just don't. That's just part of the game, and in fact, that's likely that was what happen if you look at the win rate of this backtest result here. So it was 47%. So it's slightly lower than a coin flip here every trade, and you just can't do anything about this. But what you know is that if you are on the right side, then on average you make significantly more money. Significantly is probably the wrong word, but it's 1.3 times, 1.31 times more than you make in the case when you're losing. So, and this is giving your whole trading a positive expectancy here, and this is exactly what trading is about. So all trading is about is, in fact, to find out a trading strategy or have a plan you just follow. You know it has a positive expected value, you follow the plan, and you just trade it through, because you expect this positive expectancy to continue in the future. You just can't say whether the next trade is a winner or loser, but what you can say is that after taking 100 trades or 500 trades, that then you're likely to come out ahead of this. And that probably takes some time, but no one has said that trading is a, let's call it, get rich quick scheme. But it's all about patience, in fact. And this is something profitable professional traders emphasize over and over and over again. And I think many who start out with trading just miss this point. They just think, yeah, be patient. I'm now short, and now I want to see the market move in my direction. And I give it, let's say, 20 minutes. But patience here in this case means when looking at a strategy which is generating around 1 signal per day, per trading day, patience means that sometimes it probably takes half a year, or let's say 2 years, or 1 year, let's say 2 years probably, since the strategy then shows a profit. The thing is, I mean, you're not necessarily bound to only one strategy, but you can build a strategy portfolio. So, or you can trade the same strategy, for example, here in this case, then on the this is correct here. You can also trade it, for example, then on the DAX, which we'll have a look on. So spread it over more than one asset class, but or not asset class, but in this case, another equity index, but also more asset classes like blue chip stocks here, where the only thing you need to make sure is that you have a stock which is has lots of volume, and so that way, or that said, faces a deep deep market. So there needs to be liquidity, and there needs to be many market participants trading this asset in this case. So this should be the case for most of the blue chips, like a Google or an Amazon or Netflix, for example, mainly due to the high volatility we've seen there yesterday or on Monday already starting. But also true for German stocks like Daimler or like Deutsche Bank and all this. So, but the same is true also for the FX markets. So I presented also a setup which you can trade for Euro Japanese yen. The thing is that you're not necessarily bound to only one market, but the thing is that for a specific asset class or a specific asset you're trading within this class here, it takes some time until the positive expectancy plays out. So that said, we can make things much easier. Just imagine the following: we are playing a game like hat and tails here, and then we say, let's assume that the payout is for each time head comes, I'll get 150, while every time tails comes, you get €1 from me. And now imagine the following: that the first 10 coin tosses here bring a tail. So what does it mean? Well, I'm behind €10. And that means that even though I have a positive expectancy, and this is something you can easily calculate, it's a payoff of 1.5 to 1 for me, which is positive, and we have both a hit rate of 50%. So over the long run, I will definitely come out ahead. But after the 10 first tosses, it could be that I'm behind. So what has to happen is that I'm now catching a run, like let's say, 10 runs, for example, and then I'll be ahead of €5. So making 10 times 150, which equals to 15, and then summing or overcoming those €10 loss I've seen initially. But nevertheless, obviously, it takes time. And the good thing is, while someone I'm playing this game with could easily stood up and go, when trading a highly liquid market and an asset class which is looked after or traded from a broad range of people, I can be sure that there will be a trader all the time. I'm taking the other side of my bet. And that's what trading makes special to those games, for example, to make things easier to understand. Now, let's have a look here at the DAX. You can see the adaptation already when looking at these 3 steps we go through again here. We define the open range between 8 to 9:05 a.m. German time in this case. So this differs significantly by 3:30 p.m. to 4:15 p.m. Why is that? Well, first of all, it comes down to this: we have to have someone on the other side of our bet, of our trade. And this time here at 8, we start trading in the DAX. So in fact, the S&P, for example, is special because it's nearly traded around the clock here. Even though if you trade a certain amount or have a certain trade size, then the thing is that you probably have trouble finding someone who's taking the other side of the trade then. And the thing is that in this context, we have to make sure that enough market participants are available. And this is the case when the spot market opens. So in case of the DAX, it's special because the spot market is not open at 8 a.m. German time, but this is the time when the future DAX at the Eurex opens. But Xetra opens at 9 a.m. So what we do is we wait then for the first 5 minutes to take place, to trade. because lots of volume is pouring into the market here, and this volume sometimes results in erratic moves on the upside and on the downside, but not significantly or resulting in a significant break out of this range, which has been produced between 8 to 9 a.m. And that's why I wait for another 5 minutes. This is kind of my first filter, if you want. And then I identify the advantage, in this case, not on a 50-minute time frame, but on a 5-minute time frame, on an exponential moving average 50. By the way, you could now say, okay, well, if we work with a 15-minute time frame, then the EMA has to come down to 17, probably. That's something you could, for example, test if you want for yourself. Just backtest such a strategy on the DAX on a 50-minute time frame instead of the 5-minute time frame. And work with an EMA 17 here and just see what happens if it works over long time span here in this case. And then we work with this advantage identifier, let's call it, the same way as we work with it with the S&P. We say if we trade above, we go long. If we trade below, we go short. And then we trade the break of the range in direction of the identified advantage. Stop again above or below the high low of the range. And now let me just see what will happen. But I think no, nothing will appear here. The backtest I run is simply, or is different from the one on the S&P. In this case, the backtest is run with a risk reward of 1 to 2 here in this case. So saying, for example, if we have a risk based on the open range of 25 points, then we have to double our potential reward. And that means we aim for 50 points on the upside. The result, you get to see it here. So the result is obviously positive. The hit rate wasn't that great during this time span. By the way, the reason I have only 1 year or slightly more than 1 year has to do with the simple fact that I had not enough data available here. Nevertheless, the expectancy of the strategy, if you take out all these numbers, you will find out that the expectancy comes into the same range as for the S&P, around 8 cents per euro risk. The interesting thing is that you can, based on such a breakout approach, calculate with expected value of something between 5 to 10 cents per every euro risk you should expect, which means this backtest result, even though it's only for 1 year, is quite good already. The good thing probably is that over time, here, the hit rate from, in this case, slightly below 42%, will probably go higher, even though the thing is that the payoff ratio, on the other hand, the average gain here of 157. So we traded a 10K account, 10,000 euros with 1% risk, 100 euros. And then we had the average loss trade here of 100 euros, 99.70 in fact. And so the payoff was 1.57 to 1. So that said, probably we're capable to push the hit rate slightly higher, but chances are good that the average gain to the average loss ratio, the so-called payoff ratio, would potentially drop to something like, let's say, 1.4, probably 1.3, even though the thing is that the strategy still stays profitable under such circumstances. And now, first of all, let's have a look here at the, that's not what you want to see. Sure, you want to see the market really moving in our direction. Unfortunately, it's not moving aggressively against us, but it's also not moving aggressively. Now, nevertheless, let's have a look here at the DAX then. And what can you see here? It's very simple. What you can see is that these lines, they mark our open range, which is defined again between 8 to 905 for today. So 12,700 or 701 in fact to 12,737. So this is 36 points. So this is the difference. This is our initial risk. You can see here that when we broke out with this candle, this is 9:10, yes, a.m. We obviously traded above this blue line. So trading above this blue line means in this context that we are only taking the long side, and then you see the market moves in our direction. And this red line here on the upside, this is our take profit level. So currently the market moves in our favor, moved already in our favor, unfortunately finding some kind of stronger resistance here at 12,700 and now what is this, 775, 780 here. Let's see whether we can break above that level. If we break above that level, the thing is that we have a good chance, I think, to reach our take profit level. And yeah, this is how the approach then in this case works in the current or under current no, in the DAX. I'm sorry, not on the current market conditions, but this is how the approach works then on the real market conditions today. The interesting thing is, let's have a look back here at yesterday. That was something which is also very, very interesting. For example, yesterday there has been no breakout of this open range, or if there was a breakout of this open range on the downside, you would have been stopped out. So the open range can be defined here. There's another interesting thing. You can work with several filters. And for example, in case of the S&P, you like to get to see something like that. Unfortunately, it hasn't happened. But the interesting thing is, there has been a time last year during summer months when the VIX traded below 10. And that means that volatility was really, really low. And one trading filter to avoid being stopped into a breakout trade, which needs a certain level of volatility. You need a certain level of wind, let's say, to go surfing. The same is true for trading, a breakout trading here in this case. So the thing is that yesterday, for example, in case of the DAX, volatility was enormously low, and the high and the low of this trading range here, or in this case the open range, was only something like 23 points or something like this. And what I usually do is I work with a filter saying I need at least a range which is 0.2% of the current index reading. In case of the DAX, that means we need 25 or 26 points. If the open range is lower than those 0.2%, then you don't take any trades based on the open range setup. And so, for example, this is another indicator why yesterday, for example, there has been no trade based on the open range. Today, obviously, the range was big enough. It was bigger than 25 points. Here, we already said it was 32 points. And yes, I think that's it around this topic. So the question is, do you have any questions? Do you have any questions you'd like me to answer? Else we can now switch back to the S&P here and see how it develops. If not, what we can also do is something I just recognized I haven't made a topic yet. We can have a look at how the market developed yesterday based on the setup. So you can see here those three candles, 3:30 till 4:15 p.m. GMT. I'm sorry, German time, not GMT, German time. So then you say, okay, I have the high there, I have the low there. We are obviously trading above this blue line, our trend filter. Well, this said, we take the long trade once we break out on the upside. And then the thing is that the market aggressively moves in our direction. As you can see here, obviously there's a sharp rise in prices. And then here, around this time, that was 9:50 German time, PM. I'm sorry, 9:50 p.m. German time. We took out the trade. The interesting thing now is, as you can see, we take out the trade under this market conditions nearly at the high of the trading day. Some of you might say it's purely coincidentally that this happened here in this case. Yes, even though when running a backtest and working with such an let's call it time stop approach, what you will find out is that it's not uncommon that this happens, and it results in fact in a positive expected value, positive expectancy in your trading when working with such a time stop out. So this is something, sure, you have to find out yourself, but the great thing about this is it makes things enormously easy for you in your trading, because you don't need to sit down and calculate potential targets or something, but you can say, I work with such a time stop out level, taking out the trade at this predefined time, if it's not stopped out, and that's just it. And then we go from there. And this is the same why, for example, this approach here, in fact, on the S&P is somehow it's a horrible approach, because we can't do anything but just wait. So, well, we're getting stopped out, one chance, or the market moves in our direction, we're not getting stopped out, so we take out the trade. Then if we trade within this range, we will see a slight a loss for the day. If we break out here lower, we'll take a gain, and that's just it. So that's exactly what we did yesterday. So here, for example, we broke out, we just left the trade open and took out the trade here at the end of the trading day, and that's it. So nothing like that we say, hey, that had something to do with the fact. Let's just zoom into the chart here. Let's see whether there was a region. No, I don't even think that there was kind of a potential target on the upside or so. Nothing. So it's just mainly due to the fact that we just say we worked with this time stop out and took the profit that way. That's it. Again, you can do this differently. Sure. As for the DAX, for example, the backtest result is positive. It shows a positive expected value when working with a predefined take profit level on the upside. But all in all, both approaches work, and some probably based on psychological reasons, saying I feel not really confident in calculating potential targets on the upside or on the downside, and just feel probably happier or better if they can somehow work with a predefined time stop then, and just say I take out the trade here. Okay, so that's it from my end. I hope that you enjoyed this webinar, and if you have any questions, please feel free to let me know in the chat box right now, or send them over to Admiral so they can forward them to me so that I can answer them. And I wish you all the best. I wish you happy trading. Watch your stops, and we'll talk again on Friday to each other again here. Let's have a look at the website from Admiral. So under education, Forex webinars, this is already the page which is open, but let me just show you this again here. So there's the weekly market outlook, and then we want to have a look at all asset classes. So not only equities, but also have a look at commodities, for example, precious metals, but also FX markets. Have a look on what will potentially move the market, potential trade setups. And then I'd also already recommend to register for this webinar series here on the ESMA, the new CFD regulation in Europe. And there will be 3 special webinars. 2, in fact, the one here at the 1st of August, and then the one at the 3rd of August, that will be on trading strategies and how trading under those new regulations will affect your trading strategies. This will be with me. And we'll make it a topic, probably also the breakout strategy here, how it will affect your overall trading. And that's it from my end. So have a nice day, happy trading. Watch your stops. Talk to you again then on Friday. Yes. And see you soon. Take care and bye-bye.